Hi, I'm Ben Graham. This is our global economy class, and this is our lecture on the balance of payments and exchange rates. So let's go ahead and dive right on in. And I will, I'll give you the heads up that this is some of the more challenging material we'll cover this semester. So exchange rates, right, are the rate at which one currency is exchanged for another. So dollars to yen, yen to euros, right? So we have exchange rates between any pair of currencies in the world. And the US has what's called a floating exchange rate, meaning that the value of the US dollar floats against other currencies in the world. And while the US government intervenes a little bit, we commit, as the United States government commits, not to intervene too strongly and not to sort of peg it in particular, not to target particular exchange rates against other currencies, but just to kind of let it freely float, to let supply and demand of the currency drive the exchange rate. There are countries that who have an official policy of pegging their currency to another. So, for example, a number of countries peg their currency to the US dollar. In some of the videos about financial crises you guys will be watching, you'll be exploring a scenario, well, a real life example, where the Thai baht used to be pegged to the US dollar at a rate of about 24 to 1. And so the Thai government had sort of pre-committed to intervening in currency markets to keep the Thai baht stable at about 24 baht to the dollar. So if the value of the baht would start to go up vis-a-vis the dollar, then the Thai government would print more money and put more money into circulation. And if the Thai baht started to fall against the dollar, then the Thai government would take dollars that they had in reserves and sell those onto the market and buy up the excess baht to try to reduce the supply of baht in the market and bring the value of the baht up. So a pegged exchange rate is a commitment by a government to keep their exchange rate at a relatively fixed level against some other reference currency, often the US dollar, sometimes the euro. Um, the downside of having a pegged exchange rate is that you're not able to engage in the sort of counter-cyclical inflation that we were talking about in a previous lecture, where when the economy is tanking and unemployment is high, you might want to goose inflation to get people spending money and that sort of thing. Um, and you're not able to do that if you're pegged to another currency. You don't have control of essentially if the dollar appreciates in value and you're pegged to the dollar, your currency is going to appreciate in value, whether or not that's good or bad for you. But the upside is that there is a lot of stability. If you're pegging to a relatively stable currency like the US dollar, then you have stability in your economy, and investors can sort of make predictions about the future if they trust the peg and that sort of thing. So it makes borrowing and lending quite a bit easier. Um, a second sort of downside of this peg, though, in addition to not having flexibility to generate inflation during recessions, um, there can also be currency crises when investors lose faith in the government's ability to maintain the peg. And that's in particular what we'll be talking about in our lecture on crises and sort of how those crises unfold. Um, so an extreme form of a pegged currency is a currency union. So there are a lot of countries that use the euro, right? And there are some countries that actually use the US dollar as their official currency. So in that case, it's not that you're pegged, that your national currency is pegged and you're trying to keep it at a stable exchange to the euro or the dollar, but that's actually the currency you're using. So for countries in the Eurozone, they don't have national control over the value of the euro. And so we saw that with the inability of, there were a lot of countries in Southern Europe that would have really liked to generate a bunch of inflation, in 2008, 2009, 2010. And the Germans stood pretty fast by a low inflation policy for the euro, um, which was not so good for those countries that were deep in recession. Um, so being on a common currency with other countries or committing to using another country's currency, that's an almost unbreakable peg, right? There was talk of like whether there would be a Grexit and whether whether Greece would actually leave the Eurozone and reissue the drachma, their national currency. They did not end up doing that, but it would have taken a pretty extreme step to sort of break that peg, to break that use of the euro. So the upsides are this stability and extreme ease of borrowing and trade, right? Which we really saw with Southern Europe. You know, when Greece joined the euro, it was tremendous for their economy and especially their ability to borrow. But then it had this downside later when they couldn't have inflation during this major recession and they had trouble getting out of the global financial crisis. It was a really rough time in Greece for a number of years after the global financial crisis. Okay, here's where we get into the really hard part of the lectures, where we start to talk about the current account balance and kind of how this works in the sort of national and international accounting identities. So your current account balance is just exports minus imports. What's the total value of all the goods and services that you're exporting minus the total value of all the goods and services you're importing? And that's your current account balance, right? So a current account surplus is where you're exporting more than you're importing, and a current account deficit is the reverse. Um, and that sort of an equation that I want to familiarize you with up front that we'll kind of keep circling back to is sort of how we can disaggregate sort of all the stuff we produce in an economy. So Y here is your total national income. It's the value of all the goods and services that you produce in your country, right? And your exports minus imports, that's going to be equal to the value of everything you produce domestically minus everything you spend domestically. And we break up your domestic spending sort of into three buckets. There's private consumption. So this is the stuff that individuals are consuming. There's stuff that you're investing. You can think about this as stuff that businesses are spending on, like plants and equipment and buildings and stuff like that for the future. So it's sort of stuff that individuals are consuming, or maybe firms are consuming some of this stuff, but there's stuff that we use up, stuff that we are plowing into future productivity, and stuff that the government is spending. So we have private consumption, investment, and consumption. So essentially, if we take everything that we make this year and we consume some of it and we invest some of it and the government spends some of it, if we have some stuff left over, well, that's stuff that we're exporting. If we're exporting more than we're importing, right? If we have that current account surplus, right? Then that would indicate that all this stuff we produced was more than all this stuff we used up. Conversely, if we are importing more than we exported, that means that we are consuming between private consumption, government consumption, and investment. We're consuming more than we're producing domestically. And so we call these accounting identities because sort of by definition, they have to balance out. So by definition, exports minus imports is going to be equal to the sum of everything we produce minus everything we consume, right? Okay, and we'll be talking about these a little bit, but this is stuff that you may have to circle through a couple of times for it to really click. It's not super easy. What I want to do is the key thing here, one place where students often get tripped up is the difference between a current account surplus or a current account deficit and a government surplus or a government deficit, which is probably something you've actually heard more about. Excuse me. I apologize for that. So the government surplus, the government deficit, that's something, you know, if you hear about the deficit, usually people are referring to the government deficit as opposed to a current account deficit. And a government surplus or deficit, so the government account balance is just taxes minus government spending, right? How much is the government taking in tax revenue this year minus how much are they spending this year? And since you all have been sort of at an economically and politically aware stage of life, the US government has been running a pretty consistent budget deficit every year, right? The last time we had a budget surplus was in the late 90s, and only for a very short time. By and large, we've been running government deficits almost every year, and certainly every year for the last 15 or 20 years. Right now, we're running close to $1 trillion government deficit in a single year, right? Where we're taking in a lot less in taxes than we're spending. All right. So this government deficit, it is different than the current account balance, but it does affect the current account balance because you'll notice that government spending is in here as part of our national accounting equation here. Okay. So the other term that I want to familiar, so you already have sort of, you've got current account surpluses and deficits. You've got government surpluses or deficits. Now I want to talk to you about capital account surpluses and deficits. So the current account is referring to goods and services, sort of like exports and imports of goods and services. The capital account refers to flows of capital across borders. And this is another place where we have things that sort of by definition end up equaling out, where if you're running a current account deficit, right, which means that you're importing more stuff than you're sending overseas, then you have to, by definition, right, you have to borrow to pay for it, right? So in other words, like if somebody sends me a whole bunch of wheat and a whole bunch of cars, I can send them back, a whole bunch of computers and a whole bunch of consulting services and other stuff. Like I can send them goods and services to pay for that. But if I'm not sending them goods and services to pay for that, then I have to send an IOU to give them stuff later, right? So essentially, if people send me stuff, they'll only send me stuff if I'm going to send them stuff. And I have to either be sending them that stuff now or promising to send it later, right? And so borrowing money from somebody is promising to give them stuff later. Um, so if we have a current account deficit, we're going to be, by definition, running a capital account surplus, right? Which is where you're taking in more capital than you're sending out, right? You're borrowing more than you're lending, and vice versa, right? If I am running a current account surplus where I'm sending more stuff overseas than I'm getting back, it means that I'm taking in some IOUs from other countries where they're going to be paying me later.